I'm here with Jonathen Wells, WSH Tax Professionals. Been in business 44 years. 2025, you did just over 1,300 individual returns.
Yep.
600 business returns, but you're full service.
Full service, yeah.
Everything from payroll, tax planning, estate planning, to just tax returns.
Yeah, that's right.
People walk through the door and they say, hey, listen, I want to pay less in taxes. Can you guys help me with that?
That's it. It's our wheelhouse.
That's what you
we're
do.
going.
All right.
100%.
So before we get into anything really specific, have you seen the movie The Accountant?
Oh, man. We talk about that. We got a bunch of nerds that work in the accounting world, right? Like
That's
we
a
talk
good
about being,
movie.
You know, that's
with Ben Affleck.
That's right. That's right.
So who
That's right.
won
It's a little, it's a little John Wicky because he never misses, but
Yep.
it's still pretty good.
Yeah.
That's
So
good.
are you like him?
No, but I got a guy in the back that's kind of like
him. Like he's
Yeah.
like
He's
Rain
got
Man.
animals hanging from the
Yeah.
ceiling because he's a hunter.
Okay,
he's that
got
guy.
it.
Yeah,
And Rain Man when it comes to numbers.
that's right. That's right. Yeah, he's counting cards.
I love it. Well, you joined us today just to talk to all the team, right?
Yep.
We have 25 agents roughly in the room, just trying to get some little nuances about how to not pay Uncle Sam as much as they needed to, right? And you did a great job. It was awesome. So if somebody's looking to pay less in taxes, like I'm walking through your door and said, hey, I'm a real estate professional. I want to talk me through your process.
Yeah. So obviously everybody that walks in comes through at some level of point A, right? We don't know what point A is. It could be the person that has accurate books and records to the person that's like, I don't have a single receipt to my name, right? So our goal is to take them from point A to point B, where point B is not only just being compliant, but tax efficient. So the goal is like, okay, we're going to take whatever mess you walk in at, we're going to fix you up, right? We're going to give you that tax makeover, and then we're going to make you more compliant. I like to use the crawl before you walk, before you run metaphor. And the goal there is to just, once they're done, and sometimes it's not necessarily the first year. Sometimes the first year is like, let's just get compliant. We haven't filed taxes in years. Let's get compliant. Then the next year, let's focus in on the planning. And then we're doing typically fourth quarter meetings where we're discussing the maneuvers that we want to do before year end. That's really the key. Is before 12/31, you want to do these things before 12/30, because once you get to January 2nd, year's over, folks. You're not writing checks now for that previous year. You're into the next year. So we want to
What if I
spend
have to pay
quality
my
money.
daughter still?
Yeah.
Am I getting too late?
Too late.
Shoot.
Yeah, too late.
All right.
Yep,
She did
too
a lot of
late.
work for me. All right.
Yep, can't do it. Money's got to move in the calendar year. For most businesses, we can get into details, but for most businesses,
It's just a
money.
bonus. I
money
haven't
has
paid
to
her
move.
yet.
No, that's it. It has to be on the W-2. Now, theoretically, you could still get the W-2s done. They're not due until for another 10 days or so, but yeah, that's typically how it is. So then, basically they're there. We got through it. We get it all done. Ideally, that's a comfortable environment where they are feeling like they're on the way to their goal, right? And sometimes it's a process. Sometimes it can happen right away. A lot of times it depends on what part A looks like.
Well, I think accountants kind of have a bad, like they're geeks. They sit down and they're not sociable people.
Yes.
Right. And I would walk in thinking like, if I'm in a bad spot or like I'm worried about things, right, they come for help. I want to go to somebody that I trust and like can build rapport with me, and like, I want to build a relationship over a long period of time. Not disinterest from like a real estate agent. Right.
It's not transactional.
So what are some of the key maneuvers? Let's say they got their stuff together. They've got the basics. Other than defining if they should be an S corp or a C corp or sole proprietor and all those things. But what are some of those maneuvers that you talk about?
Well, we've got a few, right? I mean, one of the more famous ones that people love to use is it's an old rule called the Augusta rule.
Okay.
And it's designed because of Augusta, Georgia, and the Masters tournament. If you love the golf metaphors, but that's really what it is.
Yeah.
And it was people that were around. They had a home around the golf course, and people would come in and they would literally rent their home during the tournament. Well, there's a tax code that basically says that you can rent your home to other people for up to 14 days a year, and it is tax-free to you, right? But now let's think about it. What if your company physically rents your home because you have staff and you want to bring them over and you have parties or you have trainings and you have things like that? Your company can actually pay you as an individual. The company gets a write-off for this, your own company, And then when you claim that income, you're no longer paying taxes. Now, you can't go crazy with it.
Okay.
Reasonability and accountability, it all matters, but it's there. We love that. We love the fact when families have their children working in their business with them and the ability to pay our kids, and we can issue them a W-2. And in the current year, you can make up to $15,000, $16,000 and not have to pay any taxes.
Okay.
Well, if I issue my child a W-2, maybe it's $5,000. They had enough. They've done enough to earn that $5,000. I pay them, right? And now the company's getting a write-off again at a higher rate, but the child doesn't have to pay taxes. And you can use that money now to even fund a Roth IRA because now the kid has earned income. So it gets pretty powerful. Again, these are in my talk, I talked about kind of the secondary colors and kind of reaching for the nickels. These are those nickel maneuvers. And so working with us, we're talking always about, yes, we understand that is the rule and this is what we can do. Now, how do we actually implement it so we're safe under audit?
Yeah.
Which is super
That's
important.
what we're all scared of, right?
Yeah,
It's
yeah,
like
yeah.
the IRS is this big, scary thing that's out there. Like, you don't want to get a letter in the mail or however they come knocking there with guns. I don't know.
Yeah,
And I hope I never
no
find
guns,
out.
No guns. No guns.
But that's what we're all scared of. It's like they don't tell us how much we have to pay. We have to tell them.
Yep.
But they do know sort of what we should pay, but they don't want to tell us.
Yep.
Right?
They do.
And they write a tax code and tax laws that are, I can't even imagine how many pages.
Correct.
And we have to do it every year.
Correct.
Got it.
Yes.
Yeah.
Yes.
I call it not fair.
No, it isn't. It isn't. And sometimes it is unfortunate because the people that can actually pay for our services, they tend to find that return on investment for paying for it.
Yeah.
And the people that can't afford it, they just can't. Right. And so it's almost like you don't know what you don't know. And I've often said this to my staff during meetings. I said, if I could just implement what I know to people that walk in the door, every single one of them's a client. But it's hard to communicate what I know to them, to give them the knowledge that they need to be able to, to do the things that we want to do to bring their tax bill down. Because in theory, if you have a good accountant, a lot of times they're free. If they're good,
or they pay you in a way.
That's it. There's an ROI.
Yes, that's exactly it. There's an ROI, just not buying real estate or buying a stock that gives you money back.
That's it.
A good accountant, a good realtor, a good attorney, a good doctor, they should more than pay for their services.
Yeah. Yep, exactly.
100%. Okay.
Exactly.
So Augusta rule. What are some of the other maneuvers? 2025.
Yeah.
Sitting down with people. What did you kind of talk about?
We do a lot of the retirement planning aspect. So a lot of times we work with the financial planners as well. So they might have their person at Schwab or Fidelity or wherever those broker dealers are that are managing their money. And so we look at it from a tax efficiency standpoint, where we're also going to talk about deferrals. Whether we want to defer some of our income into some what we call qualified plans, right? They always use these fancy terms, right? Like a qualified plan. Well, in our mind, just think 401ks and traditional IRAs. They're qualified, meaning we don't pay tax on what they earn every single year. They're qualified.
You pay later.
You pay it later. You pay it later. So we're looking at those. We're doing company matches on those, which is beautiful because it's company money, meaning anytime you say company money, tax deduction, lower our income, and we're able to pay ourselves first. So that's the big theme of tax planning is we don't want to just willy-nilly being like, I get a lot of guys that come in and they're making good money. They're like, should I buy a truck? And I'll go, do you need a truck?
Oh, this is a good question.
Right?
Yep.
And they'll go, no, I just got a truck 2 years ago. I said, understand that sometimes you give up $1 to save 40 cents. You're still out 60, bro.
Yeah.
Right? Like save the 60, right? Put that in keep it all and give Uncle Sam some, and you're still in a better spot because you have a good working vehicle. But if you need something, you need heavy equipment, stuff that's going to provide you with the ability to earn more money. Of course, that makes sense. You need more space in your office. You need this heavy piece of equipment because you move snow and salt every year and you're going to be able to bill because of it. Okay, that makes a lot of sense. Let's implement those. We can take accelerated depreciations and some of those types of things. So it's the concept is when we're working with people, it's understanding and knowledge, not just throwing darts with a blindfold on.
Well, and I hear in the real estate community all the time, well, if I buy a 6,000 pound car, all the time, like I'm serious,
All
every
the time.
conversation, if I buy a 6,000 pound car, I'm going to save, I don't know, make a number up, right?
Yes.
So is there any truth to that?
There is. So it's 6,000 pound gross vehicle weight, which isn't like curb weight. So there's a lot of cars that count. Almost every electric counts because it's got
so
that kind
heavy
of
with
towing
the batteries.
It's heavy. It's heavy, and it has a heavy towing capacity.
Yep.
But gross vehicle weight, that is true. If it's a 6,000 gross vehicle weight vehicle, you're allowed to take accelerated depreciation on that. Now, those accelerants do have certain limits to the extent that there's different codes, and we can get into I'm not going to go down the boring rabbit holes, but it exists. It's there. It's a very, very good thing. But here's the thing for real estate. This is where the realtors get it wrong. And this is where they come in and they're like, I bought this big car. And I said, I want you to understand something. We're going to take this big write-off. And then every year thereafter, you got to keep your gas, your oil, your insurance, and you got to keep your mileage too, by the way, because we need to know your business use percentage based upon your mileage. But the problem is most realtors are driving 20 to 30,000 miles in a year.
Yep.
And if the IRS is going to give us roughly 70 cents per mile, multiply that times 20,000 miles of business, that's a $14,000 cash write-off year after year after year after year. If I take an accelerated depreciation, I am locked into what they call the actual expense method for 5 years, and I can't go over to mileage. So while I might hit that home run year one, because I drive a ton, I'm actually losing in the long run. If I drive a ton, there's no way I'm buying an accelerant. In fact, I'm buying the Yugo. That's the most cash efficient or tax.
Yeah, to get the 14,000.
That's it. Because I want the big mileage write-off on the least expensive car. Because if I buy a Lamborghini or I buy a Yugo, I get the same federal mileage rate.
Yeah, that's true.
There's no difference. And so it's a beautiful thing for realtors to do mileage. And heck, it's a lot easier than having to keep receipts and things like that at the same time. Now, let's say you're a car guru and you love cars.
Yeah.
And you're like, you know what? I did well in real estate. I want the Maserati. That's the SUV. Great. And you're like, I'm not going to even drive it at 1,000 miles a year. I love that as a company car because my business use might be 100%. 1,000 miles for business is only a $700 mileage write-off, but we can now take all of the actual expenses of a low mileage vehicle and write it off. Now it makes sense because our mileage is low. If my mileage is high, I never want to buy a big car. It doesn't make sense in the long run.
Oh, yeah. No,
That's
I agree.
it.
That
But
makes sense.
if we don't drive a ton, then we lean a little more towards buying.
Got it.
Right. And leasing is not buying, folks.
Leasing is not buying.
Leasing is not buying. That's rent.
Okay. Because I have heard people that they bought something and they came to tax time. They're like, that did not go the way I thought. And they were way worse off. And you actually talked about it in the meeting today that a lot of people come, they make $150,000 a year as an example. Right. And they spend like they made $150,000 a year.
Yes.
Right. And then they're like, well, Jonathan, I don't have any money to pay this. What do you do? Like, you set up a plan? Like, what do you, like, so if people don't put themselves in that position, what are some of the things you recommend them doing?
So in essence, what ends up happening is that they just enrolled themselves into a high interest rate credit card. That's the easiest way to explain it because I think people like them. They can see the metaphor.
That's good.
Because the debt, but here's the thing. It's not dischargeable in bankruptcy. So it's kind of worse than a credit card. Like taxes are very, very sticky. They stick to us for a very long time. They're not going away. They're going to send us our reminder. So the concept there is that if we owe under $50,000, that's the current threshold, we're allowed to do up to a 72-month payment plan to pay it off. Now, I can't have the same problem next year and just add it to it.
No.
That's the problem.
Got it.
So you get
You
this
gotta
kind
fix
of
the
like
problem, the
you kind of
spending
get your
problem.
Monopoly get out of jail free card that first time. We get on a payment plan. Are they charging you interest and penalties like a credit card? They are. It's roughly, if someone put a gun to my head, I'd say it's roughly 13, 14% APR with penalties and interest. But that's still 13, 14%. I'd rather if someone take a home equity line of credit on their home and pay it off.
At 6-7%.
That's right. Even if it's 8, it's still net a little better.
That's still better, yep.
But you don't get to write it off. I'm sorry, folks. You don't get to use your home equity loan to pay off your taxes and then have a deductible mortgage interest. Doesn't work that way.
That makes sense. What about your fee? Someone comes in. Is that tax deductible?
It is for businesses, not for individuals since 2018. So it's the same with like financial service providers.
Okay.
We used to be able to write off our attorneys to help with trusts. Used to write off our financial planning fees, all that stuff. That's no longer tax deductible under the current regime and the current environment. It was pre-18. It was. But if it's a business account and the business is there, typically what we do in the firm is we'll break it up. We'll go, here's the business portion, here's the personal portion. And of course, we're going to push more towards the business portion because it benefits them more. And arguably it's safe because they're probably not in our office if they're TurboTax eligible. Right. So we're going to push more of the cost to the deductible business side.
Got it. Well, it's 60% of Americans could use TurboTax free.
Yeah.
And that's not who needs you. It's guys like me or guys that are in the real estate business and want to get a handle on things a little bit better and pay less in taxes. So we talked a little bit about buying real estate, accelerated depreciation.
Yeah.
Right. So as real estate professionals, talk to us a little bit about that. How many hours you have to spend per year, and what should we be doing as real estate professionals if this is our sole job?
Got it. So the most important thing and what I think the public hears about real estate professionals is the 750 hour rule.
Yep.
That's the number one thing that's taught. 750.
I think that was on my real estate test 16 years ago.
That is. They drive it home. They put it on tests. It's great. But they forget about a secondary rule that means that more than half of your income comes from that source. And this is what's going to keep those kind of part-timers away from being truly a real estate professional. Because if they have a side gig, if this is their side gig, even if they spend 750, that's not going to give them their ability to play all the real estate games that you might want to play for a real estate professional. But let's assume you are. Let's say you qualify. The most beneficial thing that's out there right now is the ability to buy real estate. Right now, you buy good. You're buying real estate that you feel that is going to generate cash flows. You're not just throwing bad money at it just to get the write-offs. You're buying a solid producing asset that generates cash flow.
Okay.
It's got a good solid building on it. We're not talking land, but a solid building.
Nope.
Building can be depreciated in a residential side over 27 and a half years. However, if you do what's called a cost segregation study, and that's where they walk in, they come in, and they break it down into pieces. A $250,000 building typically is about 20 to 25% of shorter-term lived assets that are now eligible for 100% accelerated under the Big Beautiful Bill.
Like carpet. Would that, or what do you mean?
It's
in this room?
tricky.
It's doors, carpet, windows.
It's really tricky. And there's a lot of, the code is heavy on this.
Okay.
So they're utilizing code, but typically it's like cabinetry on the walls. It could be some flooring. Flooring is a little tricky on flooring because they actually look at like LVL in tile different than carpet when it comes to these. Like it's complicated.
So it's not just I get to take this right off. You have to have someone come out. You pay them a lot of money to actually go through every item in there and say we can accelerate these items in the home.
And there are DIY options, but remember, folks, when you're doing the DIYs, it's very inexpensive. But the fine print is that they will not support you if you get audited. And that might be worth it to spend the extra couple $1,000s to hire the firms that really know what they're doing. They take good pictures. They give you a very good package. They back it up. They support it with tax code. And then great. Now, we as an accounting firm, we're not actually allowed to do cost seg studies for people. People call me all the time. Can you do a cost seg study?
No, you have to refer that out to
they
somebody.
Do. I have to maintain independence. I take their data and work off of it from that side. But that accelerant, it's unbelievable. It's beautiful. You can generate significant what we call tax losses. It doesn't mean you lost money. It just means that our tax return shows or looks like we lost money, which helps offset our income from our real estate professional status. And bang, we can drop a lot of taxes very, very quickly by utilizing that strategy. It's great.
That's great.
It's amazing.
All right. So if we look at it from, again, real estate vein here, I can write off mileage, or depending if I bought a 6,000 pound car, depending on for 5 years, how things kind of go there. What are some other things that you look at businesses or like ours and say, okay, they should be making sure that they write these things off?
I love this. I get, this is yet another, and sometimes my clients get a little PO'd with me, but they'll call me and they'll go, can I write this off? And my response to them is always, I don't know, you tell me. And they don't like that answer, right? They're like, wait a minute, I pay you, right? And they're doing that kind of game. And I said, I get it. The reason is I didn't do my job. My job is to educate you because I'm not there every time you're buying something. My job is to educate you on what is eligible so that when I can be your little guy on your shoulder telling you, keep your receipt, right? Or whatever. So the definition of a tax deduction is literally, it was a Jeopardy question, final Jeopardy question years ago. I got this one, Alex. We're good.
What is
a tax deduction was the answer. And it says, what is ordinary, necessary and not excessive. This was actually a Final Jeopardy question. And the answer is, what is a tax deduction? So it's ordinary for what you're doing, necessary for what you're doing, and not excessive. So, and I like to add a fourth thing, which is a given, which is I can prove that I spent the money. I saved the third-party receipt, not the credit card statement, the third-party receipt. Maybe I take a picture, I drop it into Dropbox, whatever, find a way, right? But have that receipt. But ordinary, what other people in the industry are spending. Necessary, people oftentimes get a little carried away with necessity. It doesn't mean that you're going to fail if you don't spend the money on this, but it might provide some level of efficiency so you succeed better. Hence, the necessity can be met.
That makes sense.
And the excessive piece is like, okay, we need to buy pens. We need to have pens for the Pomerleau team. Do I need to buy solid gold pens? No. Excessive.
No,
I know. As much as those pens are probably worth more than they were a month ago.
Yeah, I was going to say.
That's at a good
I
run.
look at it from a business investment.
Yeah. So that's the reason. So when you think about that and you apply those rules, that's what I try to teach my clients is so they know like, hey, I can correlate this to my business.
Yeah.
And if I can correlate it and I'm the taxpayer and I'm signing penalty of perjury on my own tax return, it's a tax write-off. Now, my job is to be like Humpty Dumpty up on the wall going, I'm sorry, you're way too aggressive. You're going to argue that your country club membership and your lifetime fitness membership is going to help you do your work better, and it's a necessity. No, it's been litigated. No. So my job is to know what's been litigated so I can pull those things out.
Got it.
Right? But I love the client that comes in where their whole life is receipted and on a spreadsheet. Because then I can go, no, yes, no. And then I can explain to them why it is. Because I want my clients to go, I believe this is a write-off because of this.
Justify it.
Justify it.
Okay.
Justify it. But you have the normal stuff. You got all your dues and your mileage and your, anything that you're spending. You might have I see coaches oftentimes. I see advertising, marketing, anything like that. These are very normal things. Where it gets art for me is when you actually step outside the box and you can start to transition your personal life and the expenses you might have in your personal life and bring them into the tax deduction fold. That's the art. We all know the easy stuff. Everybody does, right?
So if I go to dinner with my wife and we're going to Manny's and we're gonna $300 $400 bill. By the way, I don't do this. But if I did, right? We got $400, we had a great time and we talked about real estate and buying a rental property and something going wrong with our rental properties, or something in their business planning. Yeah. How much of that $400 could you say is, yes, that is justifiable, or none of it, all of it, or some of it?
Yeah, so it gets a little tricky. It gets tricky. We all want to write off our meals with our wife.
This is not like no one's holding you to this.
No.
But these are the questions I hear all the time.
All the time. I'm sorry, you cannot write off your Subway, right? You can't write off your Chipotle. Now, if I have every year, like my wife is my partner and she supports me in the firm. And in fact, she's an employee of the firm. Once a year, we have that type of meeting where we have an agenda. I have a meeting, I have notes, and we go through things in business planning and life planning and things like that. Do I write that meal off 100%? Now, there are other times we go on date night and I might go to Kincaid's.
Yep.
I still spend a lot of money. It's not tax deductible. It's date night.
Yeah, it is different.
Right? So it's different. So the concept of meals is business purpose. Now, our tax system is built upon the honor system. It always is. It's up for audit. The most important thing when I go through audits with people is that they can substantiate the expense. Rarely, yes, IRS, if you watch this, rarely do your agents actually ask the question on why it's ordinary, necessary, not excessive. You know what they focus in on? Prove to me that you didn't make the number up. They don't have time to go through a list of receipts.
Show me the receipt.
Yes.
They don't show me the receipt for this.
Time,
show me the
because they're not going through it. And if I have somebody that's clean, it's like going to the dentist if you brush your teeth 4 times a day. If you walk into my office and you got clean files, folders, and receipts that support every number that you take, the IRS is going to go, you got bigger fish to fry out the door.
Yep.
And that's the truth of it, right? But it doesn't mean we break the law. It just means that we can we be more aggressive if we substantiate better? 100%. And no agent would ever argue that. Right. And so that's the way that we want to educate our clients to be doing it the right way.
I like that. That's really good. In my SOP, is it okay that I have it mandatory in my uniform to have a Rolex?
Here's make sure that you embroider the company name on it.
If it has it here, right
turn
there.
It into a uniform.
This is uniform. Right.
That's right. Well, that's the point, right? This turns it into a tax deduction.
Yeah, what's the difference?
This little $3 embroidery just made my favorite golf pullover tax deductible. 100%. Yeah, it's great. It's great.
Or my wife's embroidery machine that does it for the business.
That's right.
Yeah.
That's good. Yep. I like it. I like thinking outside the box.
Yep,
That's the art.
Yep. But
That's
it is not something necessary for the business.
That's right.
Brand advertising.
Yep.
Yep.
Love it.
Absolutely.
I love it.
So if I'm a brand new client to you, or someone like, hey, do you have like do you have like a specific type of client that you work with? Someone's like, hey, I need an accountant, or I need some tax planning. How would they know if you're a fit?
So we work with every industry. We work nationwide. I got clients in other countries, other states. They're all over the place. I would say this is great, and I'm pretty frank with this because I've been doing it so long.
Yeah.
I used to be like, well, I really like people in real estate because no, you know what I like? I like people that are respectful, that understand we're humans, and that they are there to better themselves and learn. That's really what's important to me. But I've got people that they want to do things that are below brow. They might want to come in and try to break laws or things.
Yeah.
No, I don't want any of that. No. Right? I don't want any of that. I want people that are willing to learn, educate, but they're also very respectful. They understand they're humans. They understand that mistakes can actually happen in any world, even their world. Yeah. And that's really the most important piece. I mean, there's other language I use sometimes, right? But I think you get the gist.
Yeah. Sometimes there calls for stronger language. Mm-hmm. Yeah.
Unfortunately, the clients I do let go of, oftentimes it's because of how they might have treated a staff member. Literally. Yeah. It's not that they don't run good businesses and things. It's just that I just don't want that in my life anymore.
That means that actually means a lot to a lot of people.
Yeah.
Yep. And including your staff. And that's probably why people come to your firm and they stay. And that's
super important.
Super important. Yeah. Not too different from us. People come here and they stay. Yeah. We don't lose people.
Yep.
They love it.
Yep.
So it's awesome. I'm just really curious. How do I hide money in the Cayman Islands? I've heard again about this hiding money.
I don't know. I think
Islands.
Ask like Royal Caribbean and Carnival Cruise Lines. I think
Is that how you do it?
A way. Yeah, they're flagged over there. They're not even like they're listed here, but they're like Bahama-based companies.
Well, because the accountants always ask, do you have any foreign currency or money in?
Yeah. Well, they're
Why did they ask that question?
Well, because they know that you might be trying to earn income. We are taxed as U.S. citizens globally on all the money. And if I have money coming in from other businesses in other countries, it's off radar. There's no 1099s. There's no reporting. So they don't know. But our responsibilities, we pay taxes as U.S. citizens with a passport on all global income that we earn.
Yep.
That's why.
Okay. So if I sell real estate in California and Minnesota and Wisconsin, right? How does that complicate your life in terms of like what would be that process look like?
Yeah.
And how is it different than I sold real estate in Japan?
Yeah. So so there's different ways. If you refer, right? Realtors often refer. If you refer, it's different, right? You're just going to pay in your home state. Right? If you're physically like dual license, I get a lot of the Florida, Minnesota dual licensors.
Or California, Arizona.
Someplace warm, right?
Someplace warm in Minnesota. We get a lot of the dual license. Wisconsin and Minnesota.
Yes. So under those scenarios, one state's always going to be your resident state. One state, you're there more than the other. Now, the rules depend upon the state, but let's assume it's Minnesota. What Minnesota does is they say they're going to tax you on all of your income made in all states. First and foremost, Minnesota, that's their rule for individuals. Right? They're called a clawback state when it comes to individuals. Not the same for businesses, but individuals they are. Now, if I go to Arizona and I'm in Arizona paying their lovely 2.5% rate, which is what they are roughly, it's beautiful there versus 9.9 here in Minnesota. You're going to pay their 2.5.
Yep.
Now you'll come back here and you're going to claim that same income and you're going to pay that 9.9 to Minnesota, assuming we're in top rate, right? But Minnesota's then going to give you a credit for the taxes that you paid to that other state, but they're only going to credit you based on the 2.5. So net, they're actually like, do the math, right? They're getting you for like 7.5, right? Roughly. And that's how it works when you work in different states. Now you have to, now you asked, is it more painful for us? It is if the person doesn't have the records to show us what was earned in that state.
Yeah.
Right. If they don't know those numbers, what's earned in that state, it's very hard.
Yeah.
Right. How are we going to break it up? Again, it's an honor-based system of filing taxes and trying to do it right.
Okay.
So it does make it a little bit tricky. So just know those, but you'll know. I mean, you'll have probably maybe a different brokerage down there that hangs it. I don't know how that works.
Yeah,
but
it does. And usually they're going to pay you and you get a 1099 from different brokers.
Yeah. So at least that might be a little easier, from that side, but that's how it works.
You're just going to pay, you're going to write checks to Wisconsin, you write checks to California, or checks to Minnesota.
And if you sell a Japanese property,
And you're paying in yen?
If you pay a Japanese tax, I don't know.
I don't know either.
But if you did pay a Japanese tax, that Japanese tax gives you a federal credit. So much like states give credits, feds in other countries give credits.
Okay.
So you would pay as a U.S. citizen with a passport, you pay globally. So you would pay your taxes on everything you earn, but then you'd get what's called a foreign tax credit as long as you pay taxes in a country that has a treaty with the United States.
Okay.
And you can obviously just guess which ones don't.
I can only imagine.
You can only imagine,
Right.
yeah.
So we did talk about this big, beautiful bill a little bit here today. Tell me a little bit of the highlights in terms of what your knowledge is of it. And how that might help or hurt things going into 2026.
So big, beautiful bill, obviously passed in law, made retroactive, I think like January 19th, I believe, is when they made all these rules. Now, here in Minnesota, we don't have legislation yet as of the recording of this to know how Minnesota is going to handle it. But there's some unique things in there. From a real estate perspective, we now have a permanent bonus depreciation metric, which means that on those cost seg studies that we talked about before, we now have this 100% bonus. So before it was 100, then it went to 80, then to 60. So we're getting like a diminishing return on the value of doing a cost seg study. Now we're truly getting full bang for our buck. I can tell you the cost seg business is very happy about this, right? They were almost out of business, but now they're back in full force. So they're very happy about this, but it's very good for the real estate professionals when they're buying real estate for themselves because they have that. That's a huge piece of the big, beautiful bill. We also have the continuation of our existing tax code. Our rate structure was supposed to divert back to the pre-18, which was a higher tax rate. But they kept them, made them permanent. So again, there's no longer we have to guess. What's it going to be like in 2029? No, we don't have to guess that anymore.
It's going to stay permanent.
So we have a lot of permanence. That's really, really good. We have estate tax laws, our death taxes. We have some permanence there, which is very, very good. We have a few fluffy things which are not permanent, like we have people that are earning tips and overtime, and if their income allows, they get up to $25,000 of freeness on that. I call them a teaser because it's not permanent. It's there for a few years, right? And then we've got some vehicle interest, a personal car that we take debt on if it's U.S. made, right? Or final production is in the U.S. is the terminology they like to use. Like Nissan has plants here. You can get up to $10,000 of interest deducted on that from a personal standpoint. Another big one is our SALT limitation. State and local taxes limited to $10,000 on our long form, also known as Schedule A for our tax geeks out there. That went from $10,000 to $40,000 if your AGI is under $500,000 married, right? So it's going to affect 98% of everybody is under $500,000.
100%.
And so that's really going to affect them, and they're going to see a better bang for their buck.
Now, is that adjusted gross below 500, or is it
AGI below 500?
It is okay. Adjusted gross below 500. If you're above that,
you start to phase it out over 100,000.
Got it. Very cool.
Those are the main pieces of it. Those are the kind of the take homes that most of my clients want to know. They're always, of course, what affects me, right?
Yeah, well, that's what we all want to know, right?
What affects me? And I said, well, I think SALT will, realtors bonus will, right? Tax rates affect everybody being continuous in that environment.
For sure.
So, and again, we don't know how Minnesota is going to treat it yet.
Okay.
We'll find out in February.
Just to wrap things up here, I'm really curious.
Yeah.
Are you pro-tariff or anti-tariff?
Ooh, anytime we get into politics, I'm always
We're not politics. I'm just asking about tariffs.
Kind of neutral on things. I'm probably, I do believe, I do have a degree in economics. Of course, economic degrees do come with a bias from where you went to school. I went to the University of Minnesota.
Okay.
So they were teaching the Friedman idea of economics, and you have to go to other schools to learn other economic theory. I don't know if you knew this, economic students, but that's how it works. There's a bias to every school teaching economics, a lot of different economic theory. But I believe tariffs are inflationary opinion-wise. I do believe other countries are also kind of giving us the old screwdriver when it comes to sending stuff in here and flooding our market. So there's kind of a happy medium. I think when we find that happy medium of a 10% tariff, nobody's going to ever argue. It's when it starts to balloon up that people start to become, this is inflationary. And inflation is obviously the biggest concern to any economy. It is an interest rate, folks.
It's been an issue for
inflation.
Since COVID.
Yes.
Yeah, since 2020. Last question then. Are you then a flat tax guy?
Of course not.
Or
let's complicate the code. Give me more pages, Matt. Come on. So that's the, no, flat tax. Heck no. Now, if there was a flat tax, there's other taxes that we would be probably diving into as a firm. But no, complications, new tax laws, they're really good for business.
And I was going to say, they probably bring in
good for business.
Good for business. Well, thank you so much for being here.
Yeah, no, my pleasure.
I really appreciate tons of great information.
Yeah,
we could have like 15 different conversations about this, but yeah, really appreciate you coming.
Appreciate it. Thank you.
Thanks.